Good afternoon, everyone. My name is Ben May, and I work at Oxford Economics. And I'd just like to start by welcoming you all here and thanking you for joining us. So today, our webinar is going to be on what is next for Greece. But before we get into that, for those of you who are new to Oxford Economics, I'll just give a brief introduction. So we were founded in 1981 as a joint venture with Oxford University and are now one of the world's leading independent global forecasting and advisory firms, providing analytical tools, forecasts and reports on 200 countries, 100 industries and 3,000 cities. Before we start, just a few housekeeping points. Gabriel Sterne will provide a presentation on his recent note on exit probabilities. And we'll have plenty of time for questions at the end. So if you want to ask a question, there should be a drop-down box at the top of your screen where you can type in a question and we can then ask it. So essentially you can just do that at any time and we'll answer all of those at the end. So that's all from me for now. I'm going to now pass you over to Gabriel.
Thank you very much, Ben. It's actually really thrilled to be working back on Greece again, for as it might sound. I think both Ben and I, in our previous employment, actually I think spent the best part of at least 2 years, almost full-time on Greece. And it's very nice to team up with him today. And I'm going to be passing the control panel to him at a certain point later in the presentation. I have 2 objectives today. The first is to discuss what might happen to Greece, its bonds, possible contagion. The second is a bit more technical in nature, which is to present what I think is by far the best framework for pricing sovereign bonds, particularly when there's a risk of distress. But don't worry if you're not into distressed sovereign bonds or GGBs. I won't dwell on that too much. My mantra probably today is that in order to better understand the present, it's easy. You just need to know about the future. And that's what I'm really going to try and look forward and back out the present from the future. Now, if you were to ask me the most likely course of events for Greece in the next year or so, I think it would run as follows. I think Syriza wins the election, but it's in a coalition. Syriza, the coalition would then negotiate eventually, painfully, a new program, good, which will then go off track. And then I think it'll all end sadly for Syriza. New Democracy will win early elections and pull continued membership of the euro from the fire of a very close shave with exit. So that's what I think is my baseline. Now, if you ask me actually how likely I think that more or less exact sequence of events is, I would say not very. To be overly precise, because I've done this in quite a lot of detail, I'd attach just a 16% probability to that event sequence. But I think the more important thing that I want to do is to acknowledge that fair bond values, our estimates of future, all depend on the many other plausible scenarios. And I'm being so precise about the numbers here because I've thought very carefully about all these scenarios, and I've forced myself to attach probabilities to each and estimated the likely prices of Greek government bonds in all of them. Election outcomes, what happens to the troika program, what happens after that in the end game. And the supplementary question, which I'm going to spend a little bit of time today, is how contagious is it all? Bit of background first. Debt sustainability. Greece's debt is not sustainable and hasn't been, well, I don't know, for a decade. I mean, what do I mean by that? Well, here is the IMF stroke troika projections, debt to GDP ratio, nominal GDP, primary fiscal surplus. The yellow line is declining very nicely. So as long as you run a primary surplus, the blue line, averaging over 4% of GDP in the medium term, and as long as you get growth back, we are fine. Now, back a few years ago, they used to say about the England football team, good on paper, bad on grass. Unfortunately, they can't even say good on paper about the England football team anymore, but maybe in the future. But anyway, the point is that is exactly the thing about the Troika's debt sustainability analysis. Good on paper, bad in Greece. The proper definition of debt sustainability has to include the political context, and it never has. You know, that is what I learned, or one of the things I learned from working on crisis resolution with 2 years at the IMF. And the thing is, it is not sustainable if you have not got the constituency to support the reforms and austerity necessary. And the way it comes out is that in the IMF reviews, you have a baseline and a risk. The baseline is fine, and you read any IMF report, and it says risk after risk, 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 all on the downside. And anyone who's ever done monetary policy knows that you condition on the risk. You condition the average, not just the modal forecast. The IMF doesn't do that. It's a general criticism of IMF programs in the end, and I've keep going on to them about it. One day they'll change. I think they are getting a bit more probabilistic, but I must stick to the point here. Anyway, the point is that some risks do materialise, targets get missed, and the biggest risk of all, of course, has been political risk. I think I'm going to turn just briefly at opinion polls and then in a bit more detail later. But actually, markets too, I think, in the big, what you see there on the right-hand chart is the massive rally in European sovereign crisis yields, especially Greece, over the last 2 years. And I think certainly in the early parts of that rally, markets really weren't conditioning on risk either. And throughout that time, I think the one worrying chart is the one on the left. Because what it shows is that after the elections, the red line at the top is Syriza. They plateaued a bit. There seemed to be a glass ceiling on 30 for a while. And then, about the middle of last year, just austerity weariness, the European elections, they just took off again. And this has always been the big risk for the GGB story. And it's materialized. And I'm going to talk in more detail about what the opinions later. But I think you can see now that materialization of risk is something that is undermining the GGB price and has led to the spiking up of yields recently. The framework I want to put in place today is 3 dilemmas, tri-dilemmas, if you like. First, for Greece, I mean, it is tempting to think that the January 25th election, Sunday's election, will seal Greece's fate in or out of the Eurozone. But I think the reality is actually more complicated than that. Whether Syriza or New Democracy win the election, the new government has to balance weighty arguments for and against continued austerity required to guarantee Eurozone membership, and set against that, it has to think about how much it wants Eurozone membership, how much it hates austerity. Massive weights on either side of the scales. It's hard to be sure which way they'll tilt in the end. The IMF's dilemma. The IMF relationship with Greece and the Eurozone have come under huge strain during past round of negotiations. The IMF has plucked a definition of sustainability from who knows where, and that definition is 120% of GDP by 2020. It's actually a lousy definition of debt sustainability, which in fact should be defined as the capacity to service debts at all points in future time, a bit harder to pinpoint. But the thing about the IMF definition, it has actually proved to be an excellent stick to beat up Europe over its reluctance to provide debt relief. It allows the fund to put some dampeners on the Eurozone's insatiable desire to find temporary solutions. So going forward, I think Greece's debt presents little room for negotiation. In its most recent review, the IMF projected debt at 128% of GDP in 2020, but don't worry, 117% in 2022. So even if the Eurozone were to provide new lending, the problem with that is that it would result in a deterioration in the debt trajectory unless you slash the primary surplus. You slash the government spending, increase the primary surplus. So, or you provide more debt relief. So that's the IMF's dilemma, and it means that they're going to be placing a lot of constant pressure on the Eurozone and Greece. Now, as to the Eurozone's dilemma and the contagion fears, I mean, one of my favourite quotes from the entire Euro crisis was from German Finance Minister Schäuble back in 2012 when he said, "We need a solution for Greece that lasts a while." And that is actually what he got. It did last a while. It lasted probably longer than many thought, but it's now not lasting anymore. And I think the other thing is that, well, from the Eurozone's point of view, Greece probably is no longer so contagious after a huge fiscal effort, and that it might deserve some reward for debt relief. So you've got that trade-off there. Less contagious, more deserving. If I'm going to look a little bit about these contagion views, the first is something that I'd forgotten to look at for a year, I think, but I dug this chart out. Target 2 imbalances. Eurozone crisis veterans will remember all about these. These are the funds, the current account, capital account, balance of payments imbalances that can't be financed anywhere in the banking system, so they end up locked up in the Eurozone system of central banks. So, for example, if you withdraw money from a Greek bank, the only way that can come, the only balancing item for that, the only way it can be financed is via the European Central Bank and the European system of central banks. Now, at the height of the Euro crisis, you see that top figure, 751 billion surplus for Germany. That's fallen 38%, now 468 billion. Still enormous, actually. So although you could say from that point of view contagion has fallen, but it's fallen from the ginormous to the extremely big. But the actual, I think the reason why probably the Eurozone is more relaxed about contagion is summarised in this, which during the Euro crisis is actually one of my favourite charts of how bad things have got. Lebanese spreads versus Italy. Now, why is that such a good marker? Well, the reason is that actually, if you look at Lebanon's fundamental debt sustainability metrics, on virtually every count you can think of, debt GDP ratio, fiscal balance, etc., etc., they look worse than Italy. And yet during the crisis, they actually had lower spreads, you can see there for a while. And the only explanation for that was because markets trusted Lebanese institutions more than they did the Eurozones, which was a damning indictment. That has completely changed now. Italy's spreads, long-term spreads, well below 200, falling, probably will fall more this week, or if QE goes forward. So there must be much greater confidence within the Eurozone that contagion risks are lower. But I mean, one thing about an exit is you really can't predict what it would mean. And there's another form of potential contagion I think is very hard to gauge. Now, possibly the most important of all the huge costs would be the shattering impact of blanket media coverage of extreme Greek economic financial dislocation that I think would accompany Greek exit. For the Eurozone to force a Greek exit, it would need to refuse loan disbursements and cut off liquidity to Greece's banking system, which could be construed as just about the most powerfully destructive economic act feasible in peacetime. I mean, to put it in context, imagine if the US could credibly threaten North Korea or Iran that its banks would be closed. I mean, in that environment, I think there'd be no question of ever needing to discuss sanctions, military options. The scenario is one in which you get wall-to-wall media coverage of Greek financial system in ruins, cash points closed, human suffering, social unrest. And I think that would be really seen as Europe's disgrace. How that plays out in financial markets, I'm not sure, but certainly I think it would make, and did in fact make, Merkel blink back in 2012. So, 3 crucial stages in Greece's future. First, election outcome. Second, programme, agreements and implementation. Third, the end game. What I've just shown to the right is, in the note, I've done a very detailed scenario tree which prices bonds and exit probabilities, not just now, but it backs them out from the future and backs them out at every point in the future. So it's very, very rich in analysis. What's more, it's available to GMS and GSS clients in a spreadsheet form. Just email me if you would like to see it. The annoying thing for me is that it's all out of date on Monday after the elections. I'll have to update it, but there you go. No, nothing's perfect. The next point I want to make is on Greek opinion polls. Now, I became something of a Greek opinion poll geek, I think, in the crisis, and what we have here is just to show you that it really couldn't be any more neck and neck in terms of Syriza achieving an overall majority. The way the Greek election works, I'll spare you the details, is that if you hit 40% of all the parties that qualify for Parliament, then you get half the seats, 50 out of 150. And Syriza, in terms of the average, say, of the last 12 or 13 opinion polls, which is one each from every polling company, which stretches back just over a week, so it's a real boom industry in Greece, the opinion polls, they are on, by my calculations, 39.8. So in other words, they are a hair's breadth away from an overall majority. Now, funnily enough, you see, the other interesting thing that's happened over the last few days, and then I'll shut up about opinion polls, otherwise I'll go on forever, is the bottom blue line, independent Greeks. You can see that stops in mid-December, and that is because you need 3% to qualify. Now, the thing about the independent Greeks is suddenly, in the last week or so, they put out a real wacky advert with train tracks and the like. I can email it you. It's in Greek, though. It's very amusing. But it's basically saying that, oh, no, Syriza can't manage without us. And as a result of that ad, why I'm mentioning it is they are now, in the last few days, actually back up to 3%. And that in itself, just by increasing the number of votes out there, could be the thing that stops Syriza getting an overall majority and puts them into coalition. So I'm putting a slight odds-on coalition being needed, only 10% on New Democracy, and I think I've got 35% on Syriza getting, but definitely within a whisker of an overall majority. Now, in terms of implementation, what I think is going to be very important is at the outset, how will it play out? I think what I expect is there under the table waiting for Syriza is an offer of soft OSI, OSI being official sector involvement in debt relief, in return for Syriza signing a program. And Syriza out of that would get a slightly lower primary surplus. Now, how could that be done? Now, in one way, and I think probably in one way only, things have actually improved since the last troika review back in June. And in that is because I think that the interest rates that are charged on Greek government debt are very much floating rate ones. Something like 60% are from the European official sector. Most of those are floating rate linked to Euribor, and Euribor has fallen a lot since last June. So I think what will be offered will be almost a flooring of interest rates, and that could gain maybe over the next few years 5% of GDP. It may be enough just to allow Syriza to run a slightly lower primary surplus, maybe 1% of GDP, get that down from 4 to 3. And the other thing that they'll probably do is try and repatriate some of the funds from the Hellenic Financial Stability Fund, around 10 billion, maybe just over, are locked away at the moment. So that's what will be on offer. Probably that will be enough to eventually persuade Syriza to sign. But I would say I think the window to get that agreement will be unbelievably narrow. In Cyprus, it was less than 3 weeks from the point at which you had a centre-right president elected, and then you had panic, banks, jogs or fastening jogs, maybe runs from Laiki, Cypriot banks, and the bank closure was less than 3 weeks later. I think you could easily see something similarly happening in Greece that could really force the hands, get that announcement made very quickly. But I also think that even if that program is agreed, in a way that's the easy bit. The chances of Syriza-led coalition doing that implementation, I don't think are that high. If you think about Samaras, he was very determined. He believed in some way he really wanted the austerity. He was actually a very good manager of it. I think a lot of Greek politicians are probably better at the legal aspects and passing the legislation than actually implementing. Samaras was a very good manager of that. I just can't see Alexis Tsipras being as good. He certainly won't really believe in it, and I think that program will very likely go off track pretty quickly, bring things to a head. Once that happens, well, I won't dwell on all these other possibilities. They're in the note. They are in the scenario tree. You know, there's some chance that it stays on track, depending on which government. There's some chance, not too much, I think, of further private sector haircuts. Obviously, exit would be a disaster for the bonds. I think, in the end, the official sector will, if they want to keep Greece in the Eurozone, have to bite the bullet. Very likely, well, fairly likely, I think, that even if Syriza get in, we'll get a change of government before long, because I think they'll probably collapse under the weight of missing the targets. And as to exit, I think that is still, I think, under 20%, but it also depends on whether it's chaotic or negotiated. In terms of the bonds, I promised at the beginning not to dwell too much on the bonds, but I just wanted to show you this table, which is how you might calculate the value of Greek bonds in the worst case scenario. And you just go through the arithmetic, go through the maths, get a back of the envelope. You say, well, what will the debt be, allowing for additional liabilities that would be incurred, allowing for depreciation of the Greek exchange rate post-exit, allowing for the fact that the IMF is senior, and allowing for the fact that whatever the haircut will be, the Greek bonds after that will trade at a discount. And funnily enough, if you get a chaotic exit, you are pretty much back to the very, very floor that these bonds traded immediately after the last haircut. You could be as low as 12 cents in the euro if there's a chaotic exit, 17 cents if there's a negotiated exit. So that's the extreme scenario. Looks really bad, but unfortunately not all that unlikely. Still in the tail, but not out of the question. So the summary, what I want to leave you with is, as a result of the scenario tree, we have, by pseudoscience if you like, but from a detailed look at how the future might pan out all the way to the end game, I've got a fair valuation for the kind of middle range Greek government bond, 2032, pretty close proxy for the strip, which is the average of all bonds, of 52, which as of the 19th close of business was 6.5% below the price. So in other words, I'm really negative on the Greek government bond valuations. I don't think they're good value at the moment. I don't think they factor in the risks. I think the probability of exit I have at 18%, and then you see the other probabilities. I think a further haircut on the bonds without an exit, I still think that's really unlikely. 11%, there are all sorts of legal reasons why that would be a real struggle, and the bonds just don't amount to enough to make it worthwhile unless it's just quid pro quo of the official sector having to do the same. I think there is a chance of the programme staying intact without any need for PSI, that's private sector haircuts, or OSI. But again, I think that's fairly low. I think implementation by a Syriza-led government will be very difficult. I think in the end, the official sector will have to bite the bullet. They'll have to do a proper haircut if they want to keep Greece in the Eurozone. I also think it's very likely, 29% possibility, that within a year or a bit more you will get another change of government. So I'm going to stop there. I'm actually going to hand back to Ben, but possibly not as chairman, possibly because he has also done a note on Greece, a big thumping, whopping note in the last week on what would happen if there was a Greek exit. And he's just going to spend, I think, he's nodding at me, is he nodding at me? Spend a couple of minutes taking through just a few highlights from that note before we open up for questions. So thank you very much.
Thanks, Gabe. Yeah, so, I mean, against that backdrop, obviously, Gabe is there, suggesting there's not a huge, but certainly by no means insignificant chance that Greece could leave the Eurozone. And one thing we have been looking at is essentially what we think might happen to Greece in that event. Really, I think, obviously, the reason why Greece might exit is clear. It faces three big problems: a lack of competitiveness, a huge public sector debt burden, and limited support for relentless austerity. And it's not obvious how it can resolve those three problems within the Eurozone without being A, very patient, and B, getting huge amounts of debt relief from the rest of the Eurozone. So really, to sort of explore to what degree perhaps Syriza, etc., can really push for massive support within the Eurozone, it's quite useful, I think, to look at what might happen to Greece outside the Eurozone and whether that's really a credible threat from Greece's perspective. So I think, first of all, one of the key questions is what would happen to the exchange rate after Greece exited, and to what degree would that help or hinder it? So this chart here just really shows what's happened to the Greek export price deflator relative to the Eurozone one since it joined the Eurozone. And basically what you can see is export prices have risen a lot more in Greece than in the rest of the Eurozone. Now, to a certain degree, there's a whole stack of factors which could be causing this. But under the assumption that a lot of this is just due to cost pressures, this kind of suggests that Greece might need to see its real exchange rate fall by about 20% just to regain that competitiveness that it's lost over the past few years. Now, it's obvious if it left the Eurozone and it achieved a 20% fall in the exchange rate, that actually wouldn't really restore competitiveness fully, because inflation is bound to rise, higher oil prices would push up costs further. So we certainly think that you might need to see something like a 30% fall in the nominal exchange rate in order for Greece to achieve that. Clearly, in the short term, it's likely that there would be an even sharper fall than that, not least because there'd be huge amounts of uncertainty about what policy measures Greece would adopt, whether they would be sensible. Greece would need to build credibility before markets certainly trusted the Bank of Greece and the Finance Ministry to behave responsibly. And this, as this chart shows, often when we see these crises or troubled economies leaving a fixed exchange rate system, what often tends to happen is the exchange rate absolutely plunges before appreciating somewhat in the following months and quarters. And so certainly I think in the short term at least, you'd imagine that the exchange rate could fall rather more than that 30-odd %, perhaps even double. Clearly the size though will probably just depend a little bit on exactly how Greece exited. For instance, whether it had IMF support or not. But all that aside, in the short-term movements, we feel that it's perhaps reasonable to expect the drachma to depreciate something like 30% in the medium term if reasonably sensible economic policies were adopted afterwards. And that's important because it brings you on to the next thing. What would happen to Greek government debt? Well, certainly in the short term, if we were to see the exchange rate fall by something like 30%, that would boost, in drachma terms, the value of Greek debt to well above 220% of GDP or something like that. And clearly, that would be unsustainably high. So thinking about what that would mean for debt restructuring and the like, this chart, first of all, just sets out which sectors, if you like, own Greece's debt. And essentially what you can see is most of it, as I'm sure you're all aware, is owned by the official sector. And this in practice means that it will be certainly very difficult for Greece to walk away from its debts. In addition, it would be pretty much inevitable that it would remain denominated in euros. So the way that Greece would reduce its debt to a more sustainable level would probably be through a series of negotiations to reduce the euro value in size via some form of haircut. Our view is, whilst Greece might like to slash that debt burden to a very low level, it's unlikely that we would see such a reduction. Something like the 120% notional ratio that Gabe talked about earlier could be seen as a floor. In practice, we think that probably in the short term, Greece would be able to get wouldn't even be able to get such a good deal like that. Something like 130% of GDP in drachma terms might be appropriate. So if we were to see something like that, whilst that would certainly imply massive haircuts for those that hold Greek debt, it wouldn't really leave Greece in a position where it could go on a massive fiscal stimulus. And certainly bearing in mind that it would probably have to continue to repay its IMF debts in full, and that actually most of its other debts don't mature for quite some length of time, and in some cases interest payments are deferred. It's not really obvious that immediately after exit, Greece's fiscal position would be considerably better, and it might even, if anything, certainly if the economy fell into recession afterwards, it might even need to tighten fiscal policy somewhat. So certainly one of the, or one arguably two of the key reasons why people often put forward for Greece leaving don't necessarily ring true when you take a closer look. That said, I think there's still certainly some good reasons why Greece might want to leave the Eurozone and could eventually benefit. Clearly, when you're thinking about something like an exit, you don't want to think about what the implications are for the next quarter or two. You're wanting to think about the medium to longer term. And certainly, I think it's fair to say that obviously the combination of regaining control of your exchange rate, interest rate policy, and perhaps to a limited degree fiscal policy, would certainly mean that Greece would be in a much stronger position to be able to return its GDP to its potential level much more quickly than within the Eurozone, where pressure would remain on it to resolve its problems by austerity and deflation. And I think the other thing that people often forget is that actually leaving the Eurozone, in some senses, would reduce uncertainty for Greece, albeit in the short term it would probably result in quite a degree of chaos. Once the dust had settled, Greece would be in a position where there was a degree of certainty about what currency it was going to have in the future. And actually that might be pretty important. If Greece remains in the Eurozone and people are forever thinking, oh, it might be leaving in a couple of years' time, it's never going to encourage people to invest in the country, and that could be a real millstone around Greece's shoulders. So I think actually in the medium term that there's a number of positives that Greece could benefit from if it were to leave the Eurozone. Nonetheless, I think from taking a deeper look, we certainly feel that the grass isn't necessarily greener, particularly in the short term. And the most important thing is I don't think it would negate the need for Greece to continue its reforms. So certainly if Greece were to leave the Eurozone, reversing structural reforms isn't really an option, or at least if it is, it's likely to cause further serious problems such as falls in the exchange rate, loss of credibility, which obviously in the medium term could be hugely damaging. So I think that gives you perhaps a little bit of a flavour of the note that I've done, and obviously some of these issues we'll continue to look into in more detail. But at this point, I think I will take any questions that people have on this or any other element of Greece and what's going on at the moment. So the first question that we have come in is, actually before I do that, I'll just remind everyone that if they do want to give us any questions, if you type them in the drop-down box, then we'll go through them. If we don't have time to answer all of them though, please send us an email and we can obviously get back to you on an individual basis. And both Gabriel and my email addresses are on the screen now. So going to the first question, which is for Gabe. What events might trigger you to significantly raise your exit probability? And what are the key things other than the obvious of the election result that people should really be looking at and when trying to sort of evaluate that probability?
Yeah, thanks for that one, whoever asked it. It is actually something the whole note is designed around. I mean, if I can just put up, you know what, actually I can even put up the Excel. So, so the way it goes, hopefully you can see this sheet there, is that various events can happen. The obvious one is the election. And you can see there that, the way that my spreadsheet works is I can just change this is a Syriza majority government. Here I've got 35% for the majority, 55% for the coalition. And, just by changing this number here, say if I think really I'm going to get definitely a Syriza government, actually I can't add my percentages over to 100, but say I think it's 45%. Now what would happen there, if you now look at the exit probability, that goes up. So if you can see that the whole point of the tree is that if you look at the percentages, everything depends on the future. So if Syriza get in, and then if the program fails, then you get to this point in the tree where I think that at that point you're up to a 40% exit probability. I actually think that if you're down here on the tree, which is a new democracy government, which I've just shifted to 0, but I don't really think that. I really think 10% on that. Then even in that situation, if the program fails, then I think things are going to be a real mess if it fails under a new democracy government, and you could still get a 20% exit probability. So really there's 3 stages for me. There is the elections obvious, then whether the program fails, and even that I've compressed both agreeing a program and implementing a program. And I think that actually some of that could get really compressed, because I think once the money starts leaving the banks, the ECB is going to start screaming quite quickly and may cut off the emergency liquidity assistance, the famous ELA. And at that point, the exit probabilities get heightened. And if the negotiations don't look like they're going well, and if Germany really starts to dig its heels in, then I think you could see exit probabilities going up a lot. I mean, the one thing I would say is, in some ways 18% may seem high. My response to that is, well, if you think about it in one respect, compare it to 2012, at that point I actually had an exit probability of 50%. I never went above 50% as far as I recall, but still 50%. At the time it was quite conservative. Now if you compare that to now, contagion risks are a lot lower as perceived from Europe. They probably are actually. And you've now got a Syriza government very likely instead of new democracy. So in some respects you could say, well, shouldn't they be higher than 50%? The counter to that will be, but Greece has come such a long way. There's no constituency for exit, 75% support of staying in the euro at all costs. Surely they'll find a solution. So, maybe overall 18% now could easily change. Hopefully I've outlined the conditions that it would change. And that's, I think, the answer to the question.
Yes. We've just had a few more questions in, which are all quite similar in a way. So the first is on what would contagion look like in the event of a Greek exit? Which countries would suffer most from a Greek exit in terms of trade losses and financial write-offs? And then what is the potential cost of a Brexit to the Eurozone, i.e. what is Syriza's negotiating power? So to a certain degree, I think these are all quite similar questions, so maybe we can answer them together. So maybe I'll kick off. In terms of the direct losses in terms of trade and financial write-offs from Greece, I think the big picture is that they would be pretty small for any individual economy. And that just really reflects the fact that Greece is a tiny economy when you look at it as a share of GDP in the Eurozone. So I'm not sure really that certainly in the short term there would obviously be losses in terms of weaker exports to Greece. But I don't think that's the kind of thing that's going to plunge an economy into recession. In addition, I think the financial write-offs would be rather smaller than they were a few years ago, not least because exposures to Greece have fallen, A, because some of the debt has already been written off, and B, because some institutions will have wound down some of their exposures to Greece over the last few years. And I think a related point to that is that certainly the financial health of banks more generally in the Eurozone and the rest of the world are stronger now than they were then. So even if they are forced to take write-downs on exposures to Greece, I think they're in a stronger position to absorb those. So certainly from the direct impacts, I don't think they're going to be huge. And certainly if you were an optimist about Greece's future in the medium to longer term outside of Greece, if it were to grow much more strongly outside Greece, then for those countries that do happen to export quite a bit to it, it might be that in the longer term that they're better off having Greece outside the Eurozone. So the key issue, though, clearly is the issue of contagion, and to what degree all the indirect effects would just swamp those direct effects. Now, as Gabe just said, I think the key issue is that probably the probability of there being major contagion is now much lower than it was a few years ago, and that really reflects the fact that there's various systems in place to limit contagion. For instance, the ECB's got its OMT program, which it could use to eliminate breakup risk premia in government bonds. In addition to that, I think also governments and the ECB alike are much more experienced at dealing with these problems, and hopefully would do a much better stab of it now than they would have done 3 or 4 years ago. And in addition, probably certainly for countries like Spain, its economic position is now much stronger than it was a few years ago, and perhaps it might well be less exposed to contagion in that respect. I will pass it over in case Gabe has got any other big picture comments that he wants to make about the wider contagion.
Yeah, thanks,
issue.
Ben. I'll try and be quick. I mean, the way I see global markets and the treatment of risk in the last year or so is that really, with so much liquidity around, central bank fueled liquidity, in a way, risk gets compressed. Bond yields go down and down and down, and risk, the price, it all gets compressed until suddenly risk stares you in the face, and you suddenly think, my word, there's a real chance I'm not going to get paid back at that. And you see that in Ukraine, Venezuela, Belarus. I mean, that's just a lot of frontier sovereigns, and now of course Greece. And I think one of the problems would be is if it was perceived that there was a danger of the Eurozone falling apart. That's the point at which it gets really bad. Now, the next in line would be Portugal and Cyprus. Cyprus is small, of course, so maybe that wouldn't have a big effect. But Portugal, I think, would be the next one. And the problem there would be is if if people see that, blimey, these guys are getting 11 cents in the euro back on their bonds. Do I really want to hold Portugal? That might be a big factor, but also just that if the Eurozone maybe doesn't recover, particularly if you have falling prices for a while and the Portuguese debt metrics don't go and politics start looking dodgy, I think markets will be quick to dump Portugal too. So there could be contagion that way. But I think the ECB's bond buying capacity is so big that probably for the likes of Italy and Spain, it would take more than Greece, more maybe than even Portugal, for it to really start making bad inroads into the yields on those bonds, given what's happened recently.
Right. The next question we have is, how would a deal between a Syriza-led government and the troika, what would it look like? And what would a soft OSI imply exactly?
Okay, so what I think, if I was the IMF and the European Union, what I would be thinking is, first of all, I just cannot conceive of a proper full OSI being available. If you look at the history of the crisis, it's only give things away when you absolutely have to, and it's give away as little as possible. And it's also use debt unsustainability as a policy tool. In other words, you don't take your hands off the Greeks' neck because they might not then do what you want them to do. So what they will do, I think, is give exactly as little away as possible they can while trying to get them to sign. And what I think they can do is they can floor interest rates. Interest rates are very low in one respect, in that they're actually not paying the coupons on, if there were such thing as coupons on official debt. They're not paying the interest, but they are capitalizing that interest. And you can get that down. Partly it just comes down because it's linked to your Euribor, as I said earlier, but partly you can just reduce the spread on it. So it's almost, close to zero on official debt. And I think that would make quite a considerable difference. I don't think they can give any more than that, but that might, in terms of the debt sustainability analysis, get it sufficiently close to 120 by 2020 to allow them to disperse the extra 10 billion, and they need to disperse more, otherwise how on earth can Syriza finance a lower primary surplus? So I think that is kind of what that soft OSI is. It's lower interest payments. It's also, as I mentioned earlier, the Hellenic Stability Financial Stability Fund. Well, that's just releasing a bit more money rather than debt forgiveness. And I think that is maybe as much as they can do. The other thing they might do, actually, I do mention it in the note, is because they're so. I mean, I think that the buyback that they did earlier on Greek government bonds, it was a voluntary buyback. I thought it was pathetic and useless, actually, because it just wasn't what Greece needed. They needed money now. I think it was a waste of time. But the reason why it was so attractive to and the other thing is it was a waste of time because it's completely ridiculous. It was buying debt from state-owned banks by the state and pretending that made a difference to debt sustainability. It was just preposterous. But there you go. That's accrual accounting versus other types of accounting. Now, the reason it's attractive is because it isn't very useful. Resources would be better spent on other things, but it does actually reduce the debt sustainability ratio by 2020. So it's superficially attractive, and attractive if you're the troika trying to weasel your way out of your 120 by 2020 rule book. So I think you could also see a bit of that. That would be softish OSI, and I think that you could probably get 4% or 5% off the debt GDP ratio. By a Syriza government, the bonds are not far off 40, so you could buy them back to 50. And that might be a way of doing it as well. So I think you could see that, which would provide a limited support for bonds. But that's a soft OSI. Was that the answer to the question? Or?
I think so.
Thanks, Ben.
Right. I think there's one last question at the moment, at any rate. Why do you assign the same probability to a negotiated and chaotic exit?
Oh, that's a good question, a tricky one. And the truthful answer is, I kind of thought about it for, half an hour and found it quite difficult to take a strong view either way. I mean, one thing is for sure, that at that point there would be unbelievable anger in Greece about the treatment. And that, I have to say, quite rightly so. After everything, the whole program has, I think, been the worst IMF program in history. I've written a lot about that. Happy to send it to you. They built a program on financing that didn't work. They built a program and then revised the level of GDP down 27%. Now, the level, I mean, if you're in the US, that's, I think, equivalent to losing California and New York. I mean, it's pretty careless. And Florida, too, as I recall. So how on earth can you do budgetary planning on that? And yet the Greeks had to do it. And, and I think, okay, the Greek institutions are rotten. They've always have been rotten. But they knew that at the time, so it's no excuse. So I think there would be, what Greece has done is a 12% adjustment in the primary surplus relative to GDP, the primary balance relative to GDP. There'd be amazing anger in Greece if you're being kicked out, the banks are being shut. And I think there's a fair chance it might just deteriorate into something really nasty and, the exchange rate going out of control. On the other hand, it would make a lot of sense to get the IMF in. You'd need the IMF in. There's going to be some very difficult negotiations on debt relief with the Eurozone in that case. And I think at that point, the Eurozone would probably say, you know what, we're not going to give you any debt relief. We're not going to give it you. You've sinned, you're not signing agreements. And the IMF would come in and say, no, sign the IMF program. Then the IMF will tell the Eurozone, you have to get debt down to 130% of GDP. That is what we're thinking is sustainable. If you don't do it, we'll implement our lending into arrears policy, by which they just go and lend anyway, even if Greece doesn't pay the Eurozone back. And it would be basically better for Greece, better for the Eurozone, better all around, if at that point, the anger is swallowed, you get the IMF in, you get the proper haircut, and you get Greece back on track. And funnily enough, what I actually think would happen at then is, I used to go to Greece a lot with hedge funds and distressed hedge funds. They would be hovering around, they would be buying up assets. Greeks themselves, by that point, I think, would have probably got, well, they would have, by the time they exit, probably 40% of GDP out of the banking system and safe. If you then say there's a 50% depreciation, which would be probably a bad case, then you're looking at 80, maybe even 100% of GDP in Greek savings outside the Greek banking system, and they would fly back in, buy up the assets, and I think, in my opinion, Greece would be flying within a year, though at the time it would be absolutely awful. So that's a slight aside, but I think so. Yeah, 50-50. Hopefully, it would be an IMF program, and it would all be sorted fairly quickly, and Greece would be on the path to renewal.
Right. I don't think we've got any more questions, so I think we'll wrap it up for now. But thank you all for attending. The presentation and a recording will be sent out to all of those who have registered with an email address. But if there's any questions that spring to mind at a later date, then obviously don't hesitate to email either Gabe or myself. Thank you all again for joining us.